Good afternoon, everyone. It's 3 p.m. and time to get started. My name is Kyle Walker, and I'm the Director of Asset Management here at Peoples Company. I would like to welcome everyone to our webinar today, Big Questions in Land Management. Today, we have a number of industry experts who will be discussing input prices and the current supply issues, crop marketing and futures, the rice industry and outlook, annual return versus long-term appreciation as it relates to managed assets, and finally, succession or estate planning. I'm excited to hear from our high-quality speakers and feel these topics are timely and hopefully useful when considering your operation this spring. First of all, let me tell you a little bit about Peoples Company before we get to the main webinar. Peoples Company is licensed to complete land transactional work in nearly 30 states in our national footprint. We currently have offices in Walla Walla, Washington, San Diego and Fresno, California, Jonesboro, Arkansas, Arlington, Tennessee, Marlette, Michigan, Omaha, Nebraska, and DeWitt, Indianola, and Clive, Iowa. We've certainly seen a lot of growth over the years. Our team is comprised of industry experts across the country who find creative real estate solutions for our clients. Our core business can be broken down into 4 separate divisions, consisting of real estate brokerage, land and asset management, land appraisal services, and investments. Today, we're going to be focusing on the relevant topic of the management division. For more information on our other divisions, please visit our website at www.peoplescompany.com. A quick summary of our land management strategy. Our approach focuses on the appreciation side and doing what's best for our clients' assets long-term. This differs from the traditional management model, which is usually short-term focused with little emphasis on the future. Our models try to identify progressive operators who are aligned with the landowner's long-term goals and objectives. The operator that fits this model doesn't require constant production oversight and utilizes the best practices to increase overall productivity. Our base services include capital improvement projects, conservation assessments, USDA compliance and certification, fertility and yield documentation, custom farming, and we also offer annual aerial images of your farm. We also try to identify unproductive or the environmentally sensitive acres on each farm and utilize those acres in a more sustainable way. We normally try to deliver 2 reports to clients each year. These would include an annual business plan, which documents the current growing season and what was done the previous year, and then a summer report, which documents the summer months and what's going on throughout the year. We also offer full accounting for clients and monthly or quarterly reports as needed for that. Last year, Peoples Company became the first professional land management company to adhere to the initiatives of the Leading Harvest Standard, and we have 100% of our managed acres in the program today. The standard serves to measure sustainable agriculture practices in a way that is flexible and meaningful for all soil types, crops, farming practices, and locations throughout the U.S. It also assures that the public that their food, fuel, and fiber are being produced responsibly with a commitment to sustainable long-term practices. Currently, all of our managed acres are enrolled in the standard. To find out more about Leading Harvest, please visit www.leadingharvest.org. Now, without further delay, we're getting ready for today's speaking lineup. Before we begin, if you guys have any questions, please click the comment section below and we'll try and get them answered at the end of the webinar. So without further ado, we're going to first introduce Gaji Balakaneshan. Hopefully I got the pronunciation halfway correct. Sorry, Gaji, if not. But Gaji is the Chief Operating Officer at Midwestern Biowag. He leads and develops strategic and commercial opportunities for the business. He holds a Bachelor of Science degree in Chemical Engineering from Tufts University in Boston. Gaji will be discussing input prices for us today. Gaji, thanks for being with us. You can take over when you're ready.
All right, thanks for that introduction, Kyle. So, see, can everybody see my screen there? All right, so I'm going to start off with a little bit of background about Midwestern Biowag, who we are and what we do. So first off, for our tagline is better farming through better soil. And so for nearly 4 decades, we've been an ag retailer focused on building soil health to enable the best farm outcomes. In an oversimplification, building soil health could be represented as building organic matter for improved water resiliency and improved nutrient use efficiency. ultimately driving more profitable operations. We're often thought of as the organic guys, but the majority of our business is actually with conventional farms. We can work with any grower along what I call the sustainability spectrum, from kind of pure conventional to certified organic, to improve their soil health. To better serve the marketplace and help more farmers move along that spectrum, we're excited to announce just recently we launched the Midwestern Biowag Sustainability Challenge in partnership with the Nature Conservancy and Growers Edge. It's a multi-year warranty to adopt our approach and guarantee at least 95% of your historic yields with no drop off for the adoption of cover crops. So the key to successful cover cropping is incorporating into your agronomy plan, not treating it as an add-on to an existing plan for maximum efficiency. So we see this as a great tool to get farmers off the fence and onto a more sustainable path. So our core offering is premium low salt dry fertilizer blends, which don't damage root growth and promote long-term soil health. We also offer our proprietary TerraNew carbon-based fertilizer and BioCal soluble calcium soil amendment to accelerate the soil building process in conventional farms and open the door to more practice changes. Beyond the retail business, we also work on an advisory basis with both growers and landowners to support their soil building efforts and to improve the sustainability of their operations. So the map on the right here shows our sales footprint. We're predominantly located across the upper Midwest. The red stars here show where each of our locations are, and our sites are roughly at a 60-mile radius, which is kind of a standard service radius for retailers, but clearly our sales are far beyond that radius. And that really speaks to the fact that we have a unique product offering and approach that farmers can't really find elsewhere. But I'm here to talk about input prices, so let's give that a shot. So in what should not be a surprise to anyone, fertilizer prices, like most things, are up due to COVID, or in large part due to COVID. These charts here are from a nutrient presentation showing the last 3 years of price history for K and P and large major trade hubs across the world for each of the primary ingredients. So to explain what's going on here, I figured let's start with some fundamentals, because we probably have a wide array of backgrounds here on this webinar. So this is a cost curve for estimating the 2021 range of urea prices from CF Industries, the biggest producer of nitrogen fertilizers in the world, and where up until last year I worked. These are great tools for understanding commodity prices and are used by all major commodity producers. A cost curve is made by estimating for each region the average cost of production and freight to get to a major trade hub. The y-axis represents the cost per ton. The x-axis represents the production capacity. When you order each region from lowest cost on the left to highest cost on the right, you end up with a cost curve. So the idea behind this is that a producer will run their plant if they are able to make money on each ton. They'll have to shut down if they're losing money on each ton. You estimate demand, find the intercept on the cost curve with that vertical line, and you have a rough estimate of what prices should be. So my first boss always used to tell me, high prices cure high prices in commodities. If prices are too high, more production comes online than is needed. That would be the producers on the right end of this curve. And then you end up with surplus product. With surplus product, prices will drop a lot lower, and then production has to turn off in order for the market to come back into balance. And obviously the reverse can be true with low prices. So while short-term prices can move around for any reason, generally speaking, cost curves hold up pretty well unless fundamentals change. So this chart is from November 2020, and CF estimated that urea prices at the Gulf Coast would be $220 to $250 per short ton. Here is that same chart, almost exactly 1 year later. You can see that the y-axis went from $400 per ton up to $1,000 because the urea price roughly doubled versus the 2020 expectation. We saw in slide 3, the same effect was seen in potassium and phosphorus. So what fundamental changed? And in short, it's seemingly everything. You know, I hate the cliche, but it kind of felt like a perfect storm of events happening. I listed here a couple reasons for each of the primary nutrients. We've seen regulatory impacts. We've seen impacts to feedstocks, feedstock availability, supply disruptions from weather, energy prices skyrocketing, underinvestment in plant maintenance affecting availability. Now, obviously, everybody probably knows about the impending Russian invasion of Ukraine, which could present economic sanctions hitting one of the major global fertilizer producers, which could drive prices even higher. So I focused on supply here, but demand remains healthy for where we're at today. Here's a chart from Nutrien on the economics of P and K. In a supply-limited situation like we're in today, fertilizer prices will rise as far as crop prices will let them. According to Nutrien on this chart, crop prices are high enough to more than justify current fertilizer prices on average. So I'm sure most of you are wondering how to buy better, or at least that could be a common question. Like the stock market, if you could time purchases consistently, you probably wouldn't be on this webinar because you'd probably be on a super yacht somewhere. The best advice is generally to take layers, like dollar cost averaging into the stock market. Your ability to do that probably depends on if you can take delivery early and sit on the product, but work with your retailer on what the options are. I used to market 7 million tons of UAN for CF Industries, a liquid nitrogen fertilizer, and I've seen there can be huge disconnects between wholesale and retail fertilizer prices. Switching gears a little bit, I've never really seen good data on organic fertilizer prices. So here is our own data on organic fertilizers. On the left-hand side, you can see this spread between conventional and organic sulfate of potash. On the right-hand side, we have our own composite of major P and K sources for both conventional and organic fertilizers. On the left, you can see in roughly end of 2016, we have a fixed dollar spread, more or less, between conventional and organic SOP. And I think from the data that I've seen, that generally ends up being true between conventional and organic fertilizers. If that is true, as prices get higher, the relative premium of organic fertilizers compresses on a percentage basis. And that's kind of what we see on the chart on the right, where the conventional composite that I created here is taken off dramatically. And while the organic composite is up, it's up a lot less. And I think there's a really important assertion to make with that data. Now should be an ideal time to start considering transitioning to organic. I decided to compare current prices to prices from 3 years ago. In that time, conventional corn is up 73%. However, a common organic fertilizer program is only up about 17%. And the takeaway here is that conventional crop prices at the levels they're at today can subsidize that transition to organic. The numbers represent transition years, the 2 years before you get to a certified organic status, where you're selling the crop as a conventional price, but you have operating costs of an organic farm. So to simplify this analysis, I'm just looking at the conventional price of corn with an organic fertilizer program. And so between 2019 and 2022, the transition period under these assumptions would be roughly $300 per acre more profitable than in 2019. The transition period is typically a net investment period, and the 2 years of cash usage is one of the primary barriers to transitioning to organic. At Midwestern Biowag, we're working with a bunch of lenders for coming up with an offer for a longer-term 7 to 10-year loan program to help finance that transition period and to defer principal payments to those fully organic years when cash flow has improved. I almost hesitate to say this, but for illustrative purposes, I plugged in current crop prices into our transition economics model. And in those transition years, you could actually be looking at a net profit, not a net investment, based off current crop prices. So like I said before, this could be a great time to transition to organic. And then some details from our perspective on the organic growing process. We say the yield drag is typically 0 to 20% versus conventional, and is primarily determined by a farmer's willingness to adopt practice changes. We estimate half that drag is due to insufficient fertilizer program and half is due to insufficient labor. Labor is huge for organic. Last year, we were able to transition an Illinois farmer to organic and kept his yields flat at 200 bushels per acre, but more aggressive farmers can certainly push above 250 bushels per acre. So I started off by noting how soil health improves nutrient use efficiency. We believe a big difference between organic farms and conventional farms is that organic farmers have to rely on improved nutrient use efficiency for a successful operation due to the logistical constraints of farming organically. And an interesting observation one of our dealers made to me last year is that our approach can enable a counter-cyclical spending approach. So because P and K can be immobile in soil, you can look at building soil nutrient reserves during low price periods and draw down those reserves in higher price periods through increasing the solubility of the nutrients to become more plant available. So I covered a lot in a short amount of time. I'll stop there. So I want to say thank you to People's Company for having me on. Please feel free to submit questions here on the webinar or reach out to your local Midwestern Biowag rep for more questions. Thank you.
Thank you, Gaji. That's certainly a topic that gives farmers a lot of heartburn this spring. It's nice seeing your data, especially on organic versus the conventional dynamic and the transition years. You don't see a lot of that. Here at People's Company, we're living that. We have a number of organically managed assets, and it's the same math we go through as far as does it make sense to take an asset into the organic production, and how does that relate when you do your performance and whatnot. So it's great to hear that you're doing a little bit of that as well. So next up, we have Joe Camp from Commstock Investments presenting about crop markets and the future markets. Joe is the director of managed programs at Market Focus LLC, a division of Commstock Investments. His role is to assist producers in full service grain marketing programs offered by Commstock's line of pricing products. He is a trusted source of grain marketing advice for producers across the Midwest. Hey, Joe, you can get going whenever you're able.
Thanks so much, Kyle, and to People's Company for inviting me on this webinar today. I'm pleased to join you to give a bit of a market outlook about crops and futures markets here. We'll start, as the introduction said, about our company Commstock and the fact that I'm a broker and an analyst, which covers this disclaimer. It makes me think of a farmer who told me about being a market analyst. The only thing worse than a market analyst is the weatherman. And I thought, well, that was topical today too, of course, with the winter storm coming in and who will be missed and who won't be. I'm from Central Illinois. Commstock, founded in 1985, is based out of Royal, Iowa, the northwest corner of the state. I'm here though right now with our office in Watertown, South Dakota. It's about 3 degrees and has a wind chill of -9 degrees. We've got some colder temperatures even to come. And I think about that in contrast with where my brother and his family are, my 2 little nephews at Disney World right now, about 80 degrees. I just got a picture of them going down Splash Mountain. So, you know, that makes me think too of the big contrast in weather conditions. It always amazes me. We think about where we're at right now in the Northern Hemisphere and row crops across the Midwest. Still a season ahead of us here to kick off this spring. But right now, really in earnest, those Southern Hemisphere crops in the South American countries that are so important to our markets at the current moment. And to think again, right now, about 0 degrees, but down in Paraguay recently, temperatures up to 108 degrees. And the stress that that's created for crops down there, something, of course, that we're going to have to talk about here as a major market point, because we are looking at tightening supplies around the world for crops being supportive for price. And we're seeing that supplies are shrinking at the same time that demand is improving. We have greater commercial demand, physical need for these commodities, and we also have those commercial interests competing with new investment interests. So speculators wanting to chase the inflation hedge that commodities might offer. That's a new feature of this market over the last couple of years that is likely to, at least in the near term, continue to be a bullish factor for these markets. And lastly, I've got this point of heightened weather worries. I mentioned those that we're talking about for South America. Well, pretty soon the cycle or the seasonal will begin again as we get into the row crop season here in the US. So to cover some major market points with a few key graphics, I want to start with that South American soybean production chart in front of you, where we look at the last 4 years crops for South American countries, including Brazil, Argentina in orange, and Paraguay in gray. And then these final 3 columns showing the drop here lately in the estimates. We've long talked now about the Brazilian soybean crop coming in sharply under expectations from a couple of months ago. Argentina, that's important because they're the world's largest soy meal exporter. We're watching again in Paraguay, a crop for soybeans that's been nearly cut in half over the past couple of months. And that's important when we look at what could be better prospects for demand for our US farmers and exporters. So we're seeing those tighten supplies in South America at the same time that demand again is improving. And we can see that depicted by a chart here showing corn in the hands of major exporters. So Argentina, Brazil as shown, but also Ukraine, of course, topical again with the Russia-Ukraine conflict here, and then the United States as well. The red bars falling down to the right to show ending stocks tightening. At the same time, the gray bars for exports in these major exporting countries going up. And that could be even further the case again if we see smaller crops because of weather issues, as we'll talk about in South America, or smaller availability of supply out of, say, Russia, Ukraine, those very key Black Sea shippers that we compete heavily against in the export market. To give you a look quickly at the export status of the corn market, these graphics are powerful because they show the current pace of sales for corn in the red relative to the last year's progress in blue and the 5-year average in green. We can see that we're tracking pretty closely to the 5-year average. We are well behind on corn export sales last year. Why? Namely because we don't have the same interest currently that we did last year from China. It was China stepping in a big way last year. Starting in January, we can see the huge spike upward this time last year. Why? Because there was growing concern a year ago about the second crop, safrinha corn, developing in Brazil and the hot, dry conditions that were stressful enough to make Chinese buyers worried enough that they looked for an alternative source, and that was the US. Again, in May, there were record purchases, as we can see that big jump up in the blue mark for last year. And that's something we're watching closely right now because that same amount of sales bought last year still are outstanding as unshipped currently for US exporters. So it could be that those shipments are vulnerable to potential cancellations, even though we wonder back and forth whether or not China will actually be stepping back in again because of the strong need for grain in China, or because a shrinking of available supply out of the Brazilian crop, which could come along with, again, this potential for the second crop safrinha corn to be hurt by dry conditions. Again, this year we have La Nina in place, so it's something that the market's watching closely. Now, we do have other countries making up in part for the lack of demand from China, and one of the bright spots here has been Canada, our neighbor to the north, taking in almost 10 times the normal amount of corn so far to date this year. A couple of things going on, a drought in the Canadian prairies and in some of the key growing regions of Canada last year, but also maybe some traction for the 2-year-old US-Mexico-Canada trade deal. We'll continue to keep an eye on that. Now, export demand about a month or two ago was actually lagging behind expectations, and we didn't quite have as much optimism for it. So we had to rely on strong domestic demand. We still have all these policy questions open about ethanol, but the proof has been in production. We have seen a strong source of demand from that sector, and we're really looking forward to what could be ahead for soy-based biodiesel and renewable diesel. We talk all about these crush plants coming online in the next several years across the Midwest that could be a good source of draw for soybeans and a good piece of support for soy prices here in the US. Now, as mentioned before, these commercial interests, the processors, the feed users, they're competing now with increased interest from market speculators, managed money folks, hedge funds, but also index investors and people that want exposure to the commodity space because of what they're seeing in the inflationary storyline here. Also with the risk of war increased, there is new interest in trying to hoard commodities, and speculators want to get ahead of that. And so again, we've got this new investment demand that we're tracking. In part, as we do each week when we get a look at where the traders are positioned in each commodity. I showed you corn and the state of corn exports. Now let's take a look at soybeans and see where our traders are at in this market. We look at a graph that shows trader positions held by reportable traders like managed money, the hedge funds that can be long or short, bullish or bearish. They're bullish is shown by those blue lines to represent a hefty net long or bullish position held by those funds in the soybean space. Well, they've been buying from commercial traders who have been hedging short in those red bars as they make purchases from the US farmer. And what we see now, though, is that because that red line has become so deeply negative, it has gone along with the rapid pace and the large amount of purchases made here recently. We'll get to a point potentially where the US farmer has less to sell. Now, finally, the green line showing interest from the swap traders, which can in part represent index funds and those that want to get ahead of, again, that inflationary storyline. So something that could be bullish here as everybody competes for exposure in the commodity market. One reason you might want exposure in the commodity space is because of that inflation storyline. Now, this doesn't tell at all as we look at the M1 money supply, but it does tell us something, and that shows this huge increase over the past year and a half beyond the pandemic and the easing from the central bank that could still be with us in the future to cause inflationary pressure on the space. But back to the sort of fundamentals and the ebbs and flows of will those traders want to continue to be long in this market will still depend very much on the prospects for supply and demand. And we know how closely that's linked to weather. We see the current drought monitor across the world. We'll start down in South America as we did with the first couple of slides. And we see that southern Brazil is in dark red along with Paraguay and Argentina. Crop potential absolutely cut. Now, the next question is, right where we have the label of Brazil, where they have had mostly favorable moisture here this season, the question of whether or not they turn dry from here in a way that affects that safrinha or second crop of corn that competes most heavily with US exports. Again, it did last year in a way that produced more corn exports for the US shippers and in a way that also supported price. Now, the next storyline, again, as the cycle or the seasonal starts over, will be whether or not the Southern Plains drought stays in place and spells trouble for crop production early on in the US. Sometimes that can be the case when we have a La Nina, as we do, that's on its way out. So that's the nature of the crop markets. A quick look here at a few key points on livestock. We see that those producers are also benefiting from more favorable prices as of late. And it is very much a supply and demand feature where we see right here, all cattle and calves inventory, long period of decline was stopped over the past 6 or 7 years by expansion in the herd. Well, just recently, we see that the numbers are turning lower again. We don't quite have the calf replacements in store. And all the while, we have good demand, like the grains, strengthening export prospects for beef. And that's something that's friendly for that market. Real quick on the pork market, as it relates to hogs, we see that pork in cold storage relative to history is very light. And that in that green line there shows that stocks are very low relative to recent years. And that is because we do have strong demand both at the domestic level and better exports here. We had a record year last year for pork volume value, and so, or pork value in exports, and that's something that supports prices right now. It's been a breakneck rally over the past couple of months for hogs. To recap, what are your options here as producers? What I like to say is just generally that it's okay to be bullish and to be patient and to wait for higher prices and to market into what we currently have as a rising set of markets here. But that doesn't mean we shouldn't do something about it. And with all of the increased potential for volatility, we are encouraging hedging. So what are your options? In some way, utilizing options, considering futures and options as a hedge to lock in what are really favorable prices at the moment across the ag commodity space. Thank you.
Thank you, Joe. It's certainly interesting to hear your take. I know a lot of my clients have been calling, and that's kind of the first question I get with everything I hear these days. And should we sell? Should we hold on to what we have? And I don't know if I have all the answers, but I certainly try and help as much as I can. So especially with all the volatility in the markets, it's tough right now. So next speaker we have is couple guys that'll be talking on the rice industry. We have Milo Hamilton and Tanner Ehmke. Milo is the president of Firstgrain, an advisory service for the world rice industry. He has a bachelor's degree from Stanford University in English and the University of Missouri in economics, as well as a master's degree from Minnesota in economics. He's been involved in one way or another in the rice markets for 40 years. Tanner is a lead economist at CoBank's Knowledge Exchange Research Team, which provides market outlooks on sectors affecting rural economy, including grains, oilseeds, biofuels, farm supplies, animal protein, dairy production, specialty crops, and the energy segment. Tanner's research focuses on specialty crops and dairy. Milo and Tanner, are you guys ready to present?
We are. Yeah. Okay, so I'll share my screen. Just give me one moment. So I'll start it off, and then Tanner will come in, and then I'll conclude at the end on the market side of the thing. We have a rice, land, and the markets title for our talk. And Tanner, next slide. We have been completely upended in the last year, like other commodities, but in rice, it's a different world than the other commodities. And hopefully you'll go away with some understanding of why it's so different than any other grain commodity or ag commodity. How did I get involved in rice from the Midwest? Well, I spent 18 years buying rice for Uncle Ben's. As a buyer, I informed Mars, the candy company, with a newsletter, and we spent about $100 million across the globe on retail products. My passion is to help farmers make a profit by strategic hedging, and I can relate well to what Joe was talking about. Next slide. Why own rice land? Well, you could inherit it from your family. It could be a diversification of a portfolio. You can build a rice mill. In fact, there are a number of producers that are building rice mills in the Delta right now, imitating what's been happening the last 15 years down in Brazil, where Sakarya has been building mills down there for larger farmers. Own water rights. Rice is an aquatic crop and it's irrigated like cotton. And that gives it a stable and large advantage, which Tanner will talk about in terms of profitability. You make more money hedging. I'm absolutely in the camp of Joe Camp on that. And at the end, I will look at what the global outlook for rice is right now. I've got across the spectrum buyers, regulators, exchanges, international grain companies, and farmers, large and small, co-ops, and private mills. Next one.
Okay, I'm going to present a few of the macro issues about what's going on, all the issues affecting commodity markets and land values, and then I'm going to hand it off to Milo to talk specifically about what's going on in rice. And the reason I bring this chart up, first of all, is because this is really driving a lot of the inflation out there, in addition to some of the COVID-19 logistics issues. But what you're looking at here is the monetary policy from the Federal Reserve. And this affects all of us. The Federal Reserve has printed trillions and trillions of dollars. As you can see there on the chart on the right, that is the M2 money supply. And they did that by purchasing assets, specifically treasuries from the federal government when that debt was issued over the last couple of years. And thereby, by doing so, they were printing money. And what is inflation really? It's too many dollars chasing too few assets. And really that is, when you combine that with the supply side issues of our logistics problems and the labor constraints and what have you, some of the fertilizer problems that Gaji was talking about earlier, we have an environment for rampant inflation. How is this going to be affected in 2022 by what the Federal Reserve is going to be doing? The Federal Reserve has indicated they're going to be raising rates starting in March. The market is anticipating 3, perhaps 5 rate increases in 2022. Some economists are anticipating 7. And the Fed traditionally has increased rates by 25 basis points, or 0.25 of 1%. And they may not take that route. They may raise rates in March by 50 points, which some are fearing could be an overreaction to the inflation that we've seen of late, which is the highest since the 1980s. However, we need to keep in mind that as the Fed embarks on this hawkish monetary policy by reducing the number of dollars in circulation, by increasing borrowing costs, the Fed does not have influence on a lot of the drivers of inflation that we are experiencing right now. For instance, the shipping and logistics congestion. Interest rates aren't going to necessarily affect that. Perhaps borrowing costs will slow down the rate at which consumers buy products, but that doesn't necessarily affect the number of containers that are still sitting outside of the Port of Los Angeles, for instance. The trucker shortage, we're short about 80,000 truckers nationwide. That's an increase from 70,000 shortages of truckers pre-pandemic. No effect there really that the Fed has on the lack of truckers. And on down the line here, there's other things. China shutting down ports or cities or factories. I have listed here potential military conflict with Russia. We already need to update that slide already. This slide is already out of date. It looks like it's already happening. Then, of course, drought that drives up, that shrinks yields and raises crop prices, and that ends up adding to inflation at the retail level for consumers. A lot of things here that the Fed does not have control over. So we may have an interesting dynamic here in 2022 where we have rising interest rates, but a fairly muted impact on inflation. Now, there's a number of things going on here that are affecting the farmer's bottom line and a farmer's ability to buy land and a farmer's ability to pay or bid for cash rents on land. Number one is energy. WTI crude oil prices are rapidly rising to $100 a barrel. Last time I checked, we may already be there yet again today. We're fairly close based on what's going on with the conflict over in Eastern Europe, specifically Ukraine and Russia, and what may transpire after that. Where does it spill over next? We're not certain, but this could disrupt some fertilizer flows, as Gaji mentioned earlier. This is directly causing problems with fertilizer costs. We've got on the chart to the right, you've got long-term prices of urea versus natural gas. This is important because natural gas is the feedstock for fertilizer. Historically, there hasn't been a very strong relationship because fertilizer prices have been somewhat divorced from natural gas. It's more closely tied to corn. That has since changed over the last several months. As you can see to the far side of that chart, surging natural gas prices helped lift fertilizer prices. We'll see where this goes next, but the EU has signaled, or Germany has signaled, that they're closing down Nord Stream 2. They're not going to be turning that on, rather, and that is going to be tightening natural gas supplies. And this is in response to Russia's invasion into eastern Ukraine. Moving on, fertilizer prices here. Gaji already covered this a little bit ago, but as you can see, these are Corn Belt fertilizer prices, and The biggest increase that we're seeing at retail is with ammonia, anhydrous ammonia. Again, the feedstock there is natural gas, but fertilizer prices across the board at retail are all rising. It's not just your inputs like fuel and fertilizer, it's labor. Whatever crop you're harvesting is going to require people at some level. And as you can see here, long-term labor costs continue to go up. If you look at the far right side of that chart, labor costs, and this is again the based on USDA's latest survey, are accelerating. That red dotted line is the long-term average, and labor rates are now accelerating much faster than it has historically above that long-term average. So again, eating into the margin environment, or the margin for every bushel produced. The chart you're looking at here is non-irrigated cropland cash rents. Cash rents have been climbing long-term for a whole lot of reasons. When a farmer is able to produce more bushels, they're able to bid higher on cash rents. And last year we saw cash rents lift higher for a number of reasons. It was a very strong margin environment last year. We had high commodity prices, low input prices, phenomenal yields, and we had a phenomenal transfer payment from the government to farmers, and they bid that into land, and so that helps lift cash rents higher. The problem is, where does this go from here with rising production costs? Some economists are anticipating that we will see yet again another increase in cash rents per acre based on excess or carryover liquidity from last year's phenomenal net income environment in agriculture. However, farmers may be a little bit more cautious going forward in bidding up cash rents, or rather when they're renegotiating cash rents with landlords, given the high cost production environment. Another chart here before I start rounding out my presentation and handing it over to Milo to talk about rice specifically. Machinery costs and parts for farm machinery are accelerating to levels not seen in history ever. Again, a consequence of supply being very short, given the supply constraints in logistics. At the same time, farmers demanding and needing machinery at a very crucial time when we're short on labor, and they have the money to bid for these machines and parts. And you can see on the far right side of that chart, we are at record highs, and this will also erode or compress farm profitability. And I mentioned earlier, farm payments down appreciably or down substantially. This is going to be the biggest reason, perhaps, why we see a drop in net farm income in 2022. This is, as you can see, the last couple of years were phenomenal payments from the government with PPP loans and CFAP payments from the coronavirus programs from the federal government. Those are largely going away, and that's going to drop federal support to new lows. And then this is a quick chart on where the USDA sees profitability by region. And for our discussion here, I want to hand it over to Milo. We're going to be talking about rice. You want to look at the Delta region there. And then USDA is expecting in that southern Delta region a drop in net farm income, a very slight drop. Moving on to farmland values, they continue to be bid higher. Also, this is in the context of very low interest rates. How can we expect this to go forward in 2022? Well, when you have an erosion of profitability and a tightening monetary policy, one would speculate that we perhaps have reached the peak on cropland values. As this chart you're looking at here is farmland capitalization rate, where you're dividing essentially the cash rent divided by the land value. Still long-term, land is a better investment than treasuries. Okay, so keep that in mind, that even in this tightening interest rate environment and perhaps a tightening margin environment for agriculture, land historically has been a better return than a risk-free investment such as U.S. treasuries. And then rounding out the presentation on my part before I hand it over to Milo, how does Arkansas land compare? We're specifically talking about rice. It's where most of the rice is grown in the U.S. There is a clear favorable, or the market clearly has a favor for irrigated farmland versus non-irrigated farmland. The blue line on the left is land values for irrigated, and the orange line is non-irrigated. And at the same time, capitalization rates of irrigated has actually widened or improved over non-irrigated. Compare that to where it was 20 years ago, and that spread has only widened over time. The capitalization rate on non-irrigated farmland in Arkansas is about 2%, whereas irrigated is 4%. So clearly the market has favored an investment in irrigated farmland over time. And with that, a few thoughts here that you can see in the PDFs that will be handed out later. And I hand it over to Milo.
Thank you, Tanner. This is an interesting chart done by Purdue. Back in 20, spirits were picking up because of high prices for the commodities. And now the inputs are starting to chew away at perceptions of what they will return, and it's gone way down again. So we're in a downward progressing attitude by farmers towards and landowners towards what the future holds. Next slide. Tanner. Next slide.
I'm having some issues here. I'm sorry. Whoops. Technical difficulties. My apologies. Okay. Hold on one moment here. There we go.
Okay, next slide.
Kyle, I'm having some problems on my end. Here we go. Sorry.
Okay, rice is totally different than any other crop. It's a huge food in the world, but its symmetry is very different. Joe talked about the other crops. If you look at the top exporters of wheat, for example, they are spread out across a number of different countries. These countries export wheat, they don't import wheat, so to speak. But you look over at rice and you have the maroon line is India, which is a large producer and exporter of rice, and China, which is a green bar down at the bottom. If you take out China and just look at India and the rest of the world, the chart will look very much like the wheat chart. India exports, all the rest of them export, they don't import, but China both is an exporter and an importer. And these statistics from China are difficult to know. For example, last year there were estimates as much as 50 million metric tons of rice was fed out to animals, but it doesn't appear in their statistics. 50 million metric tons is about the total production in the Western Hemisphere for rice, which is only about 5% of the world. The majority, 80% of the world's consumption and demand is in the East Bloc, in the Eastern, Far East. And the name of my company is Firstgrain, which comes from a saying, old Chinese saying, more precious than pearls and jade are the 5 grains of which rice is first. These people have seen times when their children were starving to death and they would actually take their jewels to buy rice. We haven't had that in this country in many years. Next slide. I like to look at the relationships of rice to other things. Right now, it's extremely cheap to wheat. What the Russian and the Ukraine thing does, I don't know, but it's very likely that rice will remain depressed to corn for a while. Next slide. But if you look more closely at these lows in the ratio, I have found over time that it often signals a major low in rice and then goes higher. There are different reasons for it, but we've made a major low, and I think we're going to see higher prices. We've been bullish at Firstgrain since last summer, and that's definitely what's happened to the price. Next one. What we look at is the relationship of our market to South America, particularly Brazil, which is the largest producer of rice in the Western Hemisphere. And the price collapsed. It went very high and then it collapsed. And back in January, I was warning my customers that they have a horrible drought down there. Paraguay was mentioned, they're a large exporter of rice. Argentina down at least 200,000 to 300,000 tons. Brazil down 10% at least. And so what we've got is a picture of much lower exports probably coming out of the Mercosur, which is the major exporters down there. We don't translate production into exports very easily, so it's difficult to say. Brazil used to carry large stocks of rice, and now it carries no stocks of rice. And it's gone up 30% so far this year, starting in January. It gives you an idea of how bad the drought is, particularly up in Paraguay. Next slide. Another curious thing is it appears that the real may have made a major bottom. And why would it do that? I don't know. Investors must look upon Brazil as doing well in this commodity bull market, and maybe they're in buying for that reason. I don't know. If the real goes up, then export demand comes to the Gulf Coast for rice and also for other commodities as well. The real is a major determinant of the relative value of grain exports at the Gulf. Next slide. In addition to that, at this time of year, from January until April, we watch how high the rice price is relative to soybeans. We've got metrics and we can take it back for years, but when rice comes to a significant premium to soybeans, it inundates their market with acreage, and it happens on an even odd year. And odd years it goes down for some reason due to rotation and also the prices. Right now, the rice price is collapsing relative to soybeans, and our prediction is that we're going to have lower acreage this year. This will be the first time we've had 2 years of lower acreage, and it's very easy with rice, which is a tiny commodity compared to the one Joe talked about, and that could lead to very high prices in the following year and a trail off of demand for U.S. exports. Next one. So I'm more of a technical guy than a fundamental guy, and I have been trading this market for 40 years, and I watch trends like the oscillator, the monthly oscillator. And if you think I'm just whistling Dixie, back in 2006, I told my customers to sell very slowly because the 5-year moving average had crossed the 17-year, which is an estimate of the inflationary tendency of rice. Right now, we're at the point where this could happen again. The last time it happened was back in 2006 and 7, and it went to sky-high levels. And that was due to general inflation, due to a number of factors and a very weak dollar. This time around, it could be other factors. If you look at the dollar, it's composed of, and other currencies, they could go higher even if the dollar goes higher. For example, in Brazil, I mentioned the commodity aspect of the real, and in Vietnam and Thailand, they are taking in a lot of manufacturing ability from China, who's losing manufacturing moxie, so to speak. If this line crosses, my hunch is we're going to see a huge up move in the price of rice. The last spike 2 years ago, we predicted it back in January. So we do actually predict as well as execute. And right now we've got people on pins and needles, and I would be very light on new crop hedging right now. Next slide. To sum it up, our dashboard of trend metrics, which is in our newsletter, suggests that Asian prices remain low, but maybe turning. Production is up maybe this year, I don't know. We have India buying huge amounts of, according to Tanner, huge amounts of urea from Qatar because they can't get it from China right now. China provides 30 to 40% of their crop inputs, and they're not exporting right now. We have high transport costs, of course, which Tanner talked about, pushing down on demand. A price headwind, of course, is the dollar, but it may be more variable. We're moving into a world where the old rules of thumb may not apply as much with the dollar in control, and we might have outliers of currencies going up in some areas and down in other areas. South American production has hit a drought. We don't know how bad it is. We really don't know. And we believe that it's significant, and we just don't know yet how bad it is. Rice is cheap to wheat and soybeans, as I mentioned. The soybeans affect acreage in the US, and by April, this will all be over with, even in April, and we will have whatever we'll have to sell next year. And food inflation and crude oils rising, 2 years of declining rice stocks ahead could be the case with the acreage forecast we have of declining acreage in this year. It's out to lunch what the answer is, but I and some other people believe that it's going to go over into soybeans on the margin and leave us short of rice. Energy price puts rice price on the rise in 2022. It's a question. I think there is a connection through the fertilizer, but this is all, I've never seen a market so uncertain as this one right now. And I've been in this game for 40 years and we've done a fairly good job predicting the price. That's it. Thank you very much to the People's Company for giving us a chance to present. I'm very grateful to them, and we hope that we could return someday. But the rice market is totally different than the other grain markets. It just doesn't march to the same drummers as the rest of the grains.
Milo, Tanner, thank you guys for that well-rounded presentation. And on rice and the macro factors in general, certainly makes you want to own something real at this point. So PJ, I see that we had a question for Tanner down below. We'll try and get to that at the end of the presentation. So next we have Mollie Aronowitz speaking on annual return versus long-term appreciation on managed assets. Mollie is one of our own. I've been working with Mollie for the last 8 years or so, and we're proud to have her on our team. She recently won the Iowa chapter of the American Society of Farm Managers and Rural Appraisers Early Career Achievement Award. Mollie is our Director of Sustainability, as well as a land manager here at People's Company. She has a Bachelor of Science degree in horticulture from Iowa State, and she just has a strong connection to Iowa's landscape and a deep understanding of land stewardship, best farming practices, and appreciation to best serve our clients. So, Mollie, are you ready to present?
Yeah, thank you, Kyle. I'll get set up here. So over the next about 10 minutes, let's go over the role of a professional land manager and People's Company approach to managing farmland in a socially responsible manner. You know, a typical week for a People's Company land manager looks like meeting with farmers, walking fields, writing reports, and communicating with landowners. A significant portion of our time revolves around building out that documentation of a farm's history. We are the boots on the ground advocate for the landowners, and a lot of our work is problem solving, working with landowners and farmers to understand the opportunities of a farm, and then really connect the expertise needed to reach desired outcomes. We try to take a broader approach to the working landscape to understand the connection of how each farm interacts with the natural resources. As a professional land manager, you know, as I mentioned, we're serving as an advocate, and this includes timely and personalized communication so the landowner can be fully understand what's going on their farm, as well as the potential opportunities. We represent landowners in a wide variety of issues, and a land manager identifies and fosters relationships with farmers who are aligned with the landowner goals. And typically, the farmer that fits this model does not require constant production decision oversight. It's a farmer that utilizes best management practices and emerging technology to increase productivity on a farm. We collect and analyze data in order to build out a farm history, and we just have that ability to look long-term at a farm. And a good land manager is also able to cater a management plan specific to each landowner's needs. And this might be full-time management, while for others it might be us being involved for more short-term assistance on a short-term task. We do a lot of consulting work, maybe for finding a new tenant and writing a new lease. Maybe it's just facilitating the process of enrolling new CRP acres, or finding and supervising contractors on a farm management project. Farmland has two return components. that short-term cash yield, and then also long-term appreciation. This is income paid out annually as farm rent and then farmland value over time. And historically, you know, the industry has put a lot of emphasis on maximizing cash yield with not an equal emphasis on maximizing appreciation. You know, historically, returns for cash yield are 4%, while appreciation is 7%. So it's short-sighted to focus on cash yield at the detriment to appreciation, which is the greater return to farmland. We maintain and build long-term value in farmland by improving soil health and addressing production resiliency, you know, which ultimately then improves yield and can increase that annual cash rent. How do we approach balancing the desire to maximize annual cash rent, but also improve the farm asset? The key is the landowner taking an active role in the management of her or his farm. As an example, I work in Iowa where about 60% of the land is rented, but we tend to put more emphasis on farmers and not enough on non-farming landowners. You know, farmers with a one-year lease don't have as much of an incentive to invest in conservation because they're trying to make money in that 1 year. Conservation is a long game endeavor where each year practices, you know, builds on the previous. Landowners have the power of the lease to incorporate conservation provisions into their lease and require it. You know, this could be planting cover crops, reducing tillage, variable rate fertilizer applications. And, you know, farmers who want to grow their operation understand that they need to invest in sustainability practices to attract new investor capital. If farmers think they can grow their operation by investing in sustainability, they will do it, but they can't make money on sustainability on a one-year lease. And institutional investors are also driving environmental key performing indicators as part of their financial model. With landowner engagement, we can begin building an open line of communication between a landowner and tenant. Today's technology is providing a wealth of knowledge on the productivity of a farm. And when we take the time to analyze and layer this data, we begin to see trends in where a farm is productive and where, you know, a farm is, the acres that are just not efficiently using those crop inputs to maximize yield. Focusing on return on investment of crop inputs, like on seed, chemical, fertilizer, etc., versus maximizing yield on every acre, you know, offers the opportunity to more efficiently use our resources. And usually if we can solve those financial issues, there's almost always a positive environmental impact at the end. So an example here on the screen, these photos and two maps on the right, is a farm I manage in north central Iowa in Cerro Gordo County. And the area highlighted in that in the photo with the red arrow is acreage we took out of production and put into a wetland CRP. The northwest corner was always a wet area of the farm and pulled down the average yield every year on that farm. And it was from water running from the north, the north neighbor's farm, running south into the midfield drainage ditch and just consistently drowned out that corner. The landowner wasn't interested in putting in more tile on this farm. And so putting a CRP wetland was a great solution. Existing tile lines were disconnected and surface water channeled to this new wetland. And ultimately pulling those acres out of production improved the overall field yield average. And when we had evidence, history built up of higher yields, the tenant could justify paying higher rent on the remaining acres in production. And also the landowner had a really nice CRP payment. And then here's another farm example. This farm is in Dallas County, Iowa, just west of Des Moines. And the landowners often used the pond for family fishing and didn't like how the farm field went right up to the edge of the pond. So to give the family more privacy and improve the water quality of the pond, we planted alfalfa around the pond and then up into the northeast corner. And so in this scenario, we squared up the field for the tenant and actually made it a lot easier for him to farm. He also saw less deer damage when the field was pulled out from the timberline. The alfalfa was cut and baled a couple times during the season, offering a little extra income to the landowner on those acres. And overall field yield went up, and the tenant was willing to pay higher rent because yields and farmability had improved. Both of these farms are great examples to touch on the correlation between lower producing acres and environmentally sensitive acres of a farm. And really, we backed into conservation on these farms by addressing yield and farmability. And so these two farms examples provided great examples of ecosystem benefits. Intrinsically, we know that landscape diversity is important. Flood mitigation, downstream water quality is important. Creating insect and wildlife habitat is important. But these items are harder to sell in a farm lease and when we're in a farmland and we're in an auction setting. There is value in healthy topsoil. And this is what we are losing when we do not consider the long-term soil health and resiliency of our farmland. And so I often use this dump trucks analogy when talking about erosion and soil moving from a field. If you owned a 160-acre farm and you're losing at the national average of about 5 tons per acre per year, that's like having a 10-ton dump truck come to your farm every year and fill it up 80 times before driving away, and then just coming back the next year to do that again. Topsoil is very difficult to rebuild, and when erosion occurs on a farm, that topsoil is essentially lost permanently, and the fertility that goes with it. Erosion is a cost to farmers and the loss of fertility and organic matter. And too often, we're able to apply more fertilizer or other crop inputs, masking that real impact of erosion. Higher expenses for the same yield mean lower profits, which means, which lowers the value of the asset. Erosion is a cost to landowners and decreased value of investment. And then erosion is a cost to society, and clogged roadway ditches, increased turbidity in public waters, increased need for filtration. We see the cost in downstream management and just the quality of our public recreation. We increase long-term value of a farm when we maximize the production on the most productive acres, but then also protect the environmentally sensitive acres of each farm. And a landowner can start by having a written lease that includes conservation action items. You can begin to collect annual production data from the tenant. You can soil test on a regular basis to understand where the farm started and where there's opportunities for improvement. And you can partner with your tenant on conservation efforts like cover crops. There are federal and private programs available to help pay for many practices. And then, of course, you can reach out to a People's Company land manager for further assistance. And we're always happy to provide feedback and assistance at whatever level a landowner is seeking. And I'll finish up with that.
Thank you, Molly, for showcasing our management approach and the value of long-term sustainability efforts. It's always great to kind of walk through that with clients and prospective customers and discuss our management approach. So our last speaker for the webinar is Rena Striegel, who will be presenting on succession estate planning. Rena is a personal friend of mine and the creator of the DIRT Project, which is internationally, and she's an internationally recognized business coach and consultant with more than 20 years of experience working directly with farmers, ag leaders, and senior execs to implement strategies that create growth and profitability. As president of Transition Point Business Advisors, she leads projects in the areas of strategic planning, business succession, and employee leadership development. Hi, Rena, are you ready to present? I think you're muted.
That'll help if you can hear me, right?
There you are.
All right. So it's great to be here with everybody today. I'm going to talk a little bit about just planning for transition. I think this has to be one of the most universal challenges when you either own farmland or run a farm and trying to figure out how do you pass that from one generation to the next, particularly considering, just all the emotions and legacy that gets tied to farmland and to our farming assets. So I'm going to be talking about just a little bit about the considerations that you should have. And it's amazing that the considerations, whether you're passing land through an estate or whether you're actually transitioning a working farm from one generation to the next, a lot of the considerations are very much the same. So what I always encourage people to do when they are starting to consider when and how to get started is to really just do some baselining. And baselining in my world just means trying to figure out exactly where we're starting. And there's several different areas that you need to kind of take into consideration. First, if you're the current owner and you're trying to figure out the transition, it's really about setting some goals. If you're a person who is needing the cash flow from that land or from that operating farm, you've really got to figure out what does that mean in terms of your personal cash flow, because that's going to really impact some of the choices that you make in terms of the tools you use to get that land from one generation to the next. You also really have to consider what is your legacy story. We've really got a lot of challenges right now, and that we've got, some, century farms and other farming assets that have been in families for generations that have now been encroached by larger urban areas, by a lot of different considerations. And so really taking into consideration legacy, what that means for your family, what it means for your personal cash flow, really important to start by just setting some goals and figuring out what that means to you. The second consideration really is all of the successors. So some of you might have some on-farm successors. Others may be dealing with inheritance, which is going to be an off-farm consideration. But regardless of whether you're dealing with on-farm or off-farm, you really have to ask yourself the question, how well do they get along? In any kind of transition of any kind of business, transitioning an asset to people who don't get along with each other is very challenging. And I see farmers and landowners struggle with this all the time. And some of them just make the decision to put it in their estate plan and to pass it along, knowing that the heirs will not get along. And they just say to me, well, they can figure it out after I'm gone. I'm really going to encourage all of you who are listening today to not let that be your mantra. Do not allow that to be sort of the easy way out in this generation, because all of us are very well in tune with the stories of families who have to try to figure things out after someone has passed. And it really creates a lot of dynamics inside of a family. And some of the families that I work with have things that have happened 2 or 3 generations in the past, and that still haunts the way that family functions today. So really taking into consideration, how well do your successors get along? Can they make business decisions together? Do they enjoy having conversations about business assets? And then, of course, if you've got on-farm and off-farm, really figuring out what makes sense in terms of allowing your operators to have control over assets that they need to keep your farm viable versus creating an inheritance for those who are taking the opportunity to earn their living elsewhere. When you're also looking at successors, you've also got to think about skills and talents. Some people think that farmland is an asset that's just going to produce an income. And I think from just listening to Mollie, all of us, if we didn't have a good pulse on that before, we all can see that it's actually a pretty complicated asset to own if you don't know anything about it and you don't have people in your corner to help you make those decisions and help educate you. So you really have to think about what skills and talents do your inheritors or your successors have, and then of course making sure that they've got proper knowledge or training, or if they don't have that, the right professional team. professional teams in succession planning or any kind of business transition are really, really important. And I think sometimes we underestimate the importance of those advisors in these kind of conversations. The tools and the things that we have at our fingertips to help these farms transition with a lower tax impact to the family, the way that they can pass in terms of not just getting handed deeds, but putting them inside some tools that can help to really shape that asset and make it a lot more higher productive in terms of the income that people can earn and the way that they can leverage that. It's really important. And if people go into just a straight transition without having the right professional team around them, sometimes they miss out on opportunities that they would have otherwise had simply because they don't know about it. We have a lot of professionals in the marketplace right now that are really trying to capitalize on succession planning as an income stream. And so really being able to assess your professionals and understand if they're the right people to be helping you make these decisions is really important. And I'll talk about that in a little bit more detail in just a second. So once we kind of get a baseline, then we can actually start looking at what we want to do with the asset, whether it is gifting in life, whether it's selling it to the successors during our lifetime, or whether it is passing that asset as an inheritance through an estate plan. But what you really want to be considering in terms of the people component of this is all of your stakeholders. And if this is a family asset that's being important or being transitioned, it's actually really important to not just sit in a corner and try to figure this out on your own, but really to include your family in the decision and in the conversation. So what we know is that regardless if you're a transitioning owner, whether you're the successor, whether you're a non-family successor, or whether you're getting this asset as an inheritance, everybody wants to know kind of these three things. They want clarity to know what has been planned. They want certainty that time, effort, resources, and sweat equity are going into something that they can count on. And of course, everybody really wants open and honest communication. When we have secrets around these kind of things, it creates a lot of stress and anxiety for people. If it's going through an estate plan, people feel uncertainty about, well, I don't know what I'm going to get. I don't know what this means for my kids. What if I have to make decisions with siblings or other family members that I don't trust or that I don't communicate with now? So there can be a lot of stress and anxiety that gets built around the fact of uncertainty. So if you're in a position where this is starting to be a conversation or starting to be a thought process, I'm going to really encourage you to just make it very transparent. The more transparent it is, it's amazing how the stress and anxiety can go down. It oftentimes opens up the conversation to be able to talk about more important things than the what is going to happen, but to really understand some of your whys, some of the reasons why this asset's important. It allows for the transition of knowledge. So that is the relationships with professionals that are currently serving the generation that owns the asset, as well as just all the other really important things that need to be known when we're passing farming assets from one generation to the next. So regardless of what it looks like, whether it's during life transition or an estate transition, openness, open communication, honesty, and even if it is not going to be equal to all, it's really important that people know what's going to happen with the assets so that they can plan accordingly. This is really, really tough. And I fully acknowledge that. I know some of you might be sitting on this webinar going, there's no way that we can have an open discussion about that. And it probably isn't something that you just sit down and go, okay, Rena said to speak open and honestly, so we're going to. There's probably going to be some steps that you're going to step into that. There's going to be preparation that you do, and we can certainly provide some tools to help you with that as well. So here are my top tips for those of you who are wondering how some of the greats manage farm transitions without tearing their entire family apart or ruining their cash flow. So first of all, don't put it off and don't avoid it. So this is one thing that we have seen in generations past where people just simply didn't talk about it. They didn't plan for it. And that's why we have owners that are, reaching the later years. And we have farming heirs right now that are in their 50s, 60s, and 70s that still don't know what's going to happen with the farmland. This creates just a ton of tension, tons of family dynamics, and it really creates an environment for opportunistic people to sit in the sidelines waiting for a family blow up to get a farm on the auction block. So I'm going to encourage you to please not put it off and to not avoid planning for it. If you can share goals and expectations openly with your stakeholders, and this should include your in-laws, which I know the in-laws are favorites for being put to the side or trying to be kept out of the conversation. I'll just tell you, in-laws are going to influence this discussion, whether you include them at the table or not. If you decide not to include them, their spouses are going to go home, try to tell them what was said at the meeting. It's going to create an absolute escalation of emotions and opinions that are very difficult to deal with. So I'm going to include you to just have them at the table right from the very beginning. If you can share your goals and expectations, that oftentimes just settles everybody into a smooth transition conversation. When you leave people out or you try to do this without including them, you're going to get a lot of kickback from that. Another top tip is to engage professionals who are experienced in farm transition. I'm going to encourage you to seek out specialists and to be really wary for conflicts of interest. There are a lot of people in the succession planning or farm transition game that actually make their income off of selling products. That is not necessarily a bad thing, but just make sure that when you're dealing with professionals that you know how they're getting compensated, that you're very aware of where and how they're making their money so that you can take their advice for what it is and to make sure that you're not getting steered incorrectly. We unfortunately have a lot of bad behavior out there, and we've got some farms that have gotten into some pretty bad and precarious positions because of poor advice from people who were maybe not as experienced as they should have been. So I'm just going to really encourage you to be careful in your selection of the professionals that you work with. And then my fourth tip for you today is once you pull that trigger to start, don't stop. There are very tough situations that can happen in farm transition, which oftentimes make families just shut down, put the conversation to the side. They might not pick it up again for 2, 3, 5, 10 years. And so I'm going to just encourage you that once you start to just keep going, use your momentum to push through those tough conversations, engage your professionals to help you with those, and to just make sure that even if you're an active farming operation, we all know that there's going to be business cycles for you that make working on things like succession and transition really difficult. And so you've got to kind of set your calendar around those things. So the way that I like to coach my operators is to say, you know, you do your work in your downtime. So your work should be making decisions, meeting with professionals, talking to family, whatever that is, in the times of your farming cycle where your activity is lower. When you go to work, and let's just say you're a row crop operation in Iowa, your big work is going to happen, you know, between kind of April and May, all the way through to maybe October or November. During that time, you're going to be working, your professionals should be working on something for you. And so in that summertime, in between spraying or in between baling hay or whatever you're doing, that's when you need to schedule the time to meet with professionals, give them their next tasks, and so that they can be working while you're doing your important work of getting crops in or getting crops out. If you schedule your work around your farming cycles, you're going to find that even though you may not talk about it or maybe not even think about it for a couple of months at a time, the work is still happening because your professionals have been deployed to get that next piece in place. So those are kind of the top tips I have for you. I know it's really complicated. So of course, if you're sitting there going, okay, sure, Rena, just know we have a lot of tools and resources that we can help you either get that conversation started with your family, help you to engage the right professionals, or at least know where to find them. And of course, we've got lots of tools, worksheets, checklists, whatever we can do to help support you. This is our passion. This is our kind of life work at Transition Point, is to help make sure that farms transition smoothly, and we keep farmers farming, and we keep land owners happy and profitable. So if we can help you at all, please let us do so. Thank you for having me on today.
Thank you, Rena. I always enjoy hearing you talk. It's such a relevant topic and surprising how many landowners, do not have a succession plan in place that I come across at least. So, I see there was just one question from everybody online, and so I'll start off that with Tanner. Tanner, quickly, can you talk a bit about cap rates and how rising interest rates are impacting?
Yeah, I just replied back to PJ's question, but in theory, if borrowing costs were to increase with rising interest rates, that put downward pressure on farmland values. And as a result, if we're going to assume that cash rates would be unchanged, then that would mean the cap rate would go up. But it all depends upon what happens with cash rent. If cash rents also came down, then that would put downward pressure on cap rates.
Okay, thank you. And we're getting short on time, so I'm going to probably limit this to maybe one question for each person. But is Gaji, quickly on a per acre basis, how do organic inputs and machine operations compare to conventional crops or their counterparts in the conventional world?
Yeah, it's an important question. I think from our numbers, I'd say roughly $100 per acre is the increase versus conventional. Remember, you're not spending anything on chemicals, so you have a bit of savings there. So I think that's a fairly big number. And I'd say it's about half split between increased labor, which is a big component of organic operations, and then about half on the premium for the fertilizer side. But on the flip side, you typically expect at least a 3x sort of ROI on that additional spending due to the higher value of the organic crop prices.
Okay. Well, thank you. Joe, you're up next. You get the fun question that I think a lot of people are asking, but if Russia invades Ukraine, what do you anticipate happening in the global commodity prices, specifically corn and soy, here in Iowa?
Yeah, we certainly saw some bit of that reaction or potential response here in today's market session, starting with the overnight futures that were sharply higher. And why would prices be higher for crops? One is because, as mentioned in the presentation, it could lead to better export potential for U.S. farmers and shippers. Why? Because the Black Sea growers like Russia and Ukraine are huge exporters of grains like wheat and corn. So that's something we'd expect to continue to be supportive, but only as long as we don't get to a point, or until we get to a point like Gaji mentioned in his presentation, that we would see maybe demand destruction from high prices starting to encourage price rationing and ultimately turning down eventually to a response in lower exports to follow. So definitely higher to start, commodity inflation and the hoarding that we've seen in response. And then maybe an offsetting effect eventually, though, if we see an overall risk off type reaction, stocks really sell off hard, everybody wants to get out of everything. The dollar rising could be negative for exports and investment interests. So a split reaction, but so far it's spelling out higher potential for these commodity prices.
Certainly a scary thought, I guess, long term. So Milo, sitting here in Iowa, I don't know a lot about the rice markets. I go down to the Delta once in a while and I see the beautiful fields, but how does the rice market in the Western Hemisphere, specifically the US and Arkansas, compare to the rest of the world? Do we have a pretty good foothold as far as our production, or are we a small portion of that?
We're a small 5% of the world's rice is consumed and produced in the Western Hemisphere, and it's highly protected because people have milling assets and they want to protect their farmers. So they're reluctant to let the cheaper rices out of Asia come into their markets. And that has so far dominated despite the lower prices for rice out of Asia. That may change if we get into a shortage situation the next year or so. But right now, a lot of the rice that trades comes down the Mississippi River as paddy rice and get exported. That's starting to happen in Asia between Vietnam and Cambodia and a little bit with India, but generally rice does not trade paddy in Asia. It has to do with culture and everything. But in the Western Hemisphere, the paddy rice is just like corn or anything else. It's something that's bought and processed in another country.
Interesting. Do you ever see just a potential for that Western market to threaten our market, or to where we would want to get into more specialty organic type rice or something along those lines?
Well, that's happening. Tanner and I did a study on the importation of rice from Asia for the aromatics, particularly jasmine and to a lesser extent basmati, and that's a growing market. The only market in the Western Hemisphere for rice is growing in the US, and that is due, we think, in part to expats coming from India and other countries in Asia and settling here and wanting that type of rice. And I think it's Pew Research that estimates that the Asians could be the biggest minority in the United States in the next 20 years and will continue to increase their demand for these exotic type rices. And farmers are growing it here. Both the retailers and the farmers are doing very well within that narrow range of growing jasmine in this country. Basmati is a different cat. But in jasmine, I think we will continue to see more competition from US farmers to get in on that.
All right, thank you. Real quick, Mollie, thinking about conservation practices on the farm, how do you prioritize, what's most important, or as far as your management decisions when you get a new farm, how do you go about that process as far as figuring out where to start?
Yeah, that's a great question. We can really put it in two buckets of in-field practices like reduced tillage, split applications of fertilizer, cover crops, and then there's those edge of field practices like saturated buffers, bioreactors, and practices that are done at the field border as really like a last ditch effort to remove anything that wasn't controlled using in-field practices. And so I like to start with those in-field practices because we've talked a lot about how topsoil in the field is keeping that topsoil in the field is critical. We know building soil health and resiliency adds to the value to the landowner and farmer. But those edge of field practices have tremendous value for the larger landscape, but they don't necessarily increase yield on your farm. So the idea that neither farmers nor landowners have a positive financial outcome to pay for edge of field practices. So this is a great spot to try to grab private or public funding through cost share programs to make the most sense to get that work done.
All right, thanks, Mollie. Rena, I guess the question would be, when is the best time to have a succession plan in place? Is that when you get married and you buy your first farm and you have your new baby is born, or do you recommend waiting later in life? What's your thoughts on that?
Well, that's a great question, but there's actually like 3 layers to it. So if you're talking about a pure succession plan where we're transitioning from generation to generation, and we've got an active farmer, I usually say start actively doing your succession plan or working on your succession plan 10 years before you think it's your last year of farming, even though we know that there's never a last year of farming if you're in farming. So there's that. Now, then there's also the estate plan, which if you own assets like farmland, you should absolutely have an estate plan in place that says what you want to have happen with that farmland. And what's really shocking is there is a lot of people that don't even have an estate plan in place. So there's no will or trust that says what will happen to the farmland should that owner pass. So you could have a succession plan, you could have an estate plan. And of course, if you're a young farmer and you've got just a baby, then, really, you probably are looking at a continuity plan to say, okay, if something was to happen to me, let's say I got hurt, or let's say I passed away and now my spouse owns this. So I've got an estate plan, but then also a continuity plan that says what would happen if something bad were to happen to me and I couldn't farm this as my way of living. So you really got kind of 3 considerations inside of that question about what you need. Some people need all 3, some people just need 2. And then maybe some of you are sitting there with 2 and you're ready for the succession plan. So they all come into play at different stages of life.
And that's why you call Rena, because she can walk you through that. And it's definitely more of a complex question than just when do you need it. So, well, I want to thank everybody for coming today and being on the webinar. I think we had some good topics, and hopefully everybody listening you know, enjoyed being with us. It was our pleasure hosting it. I hope you all gain a little bit of insight. Please like and subscribe our website or go to peoplescompany.com to get the current and most up-to-date information. I believe we're going to have this website out to everybody that subscribed. And if you're interested in learning more about our services, please go to www.peoplescompany.com. Thanks, everybody.